2019 saw very strong returns from global markets, but what we saw, if you look a bit deeper into it, is that there was an acceleration of the trends in recent years, which is that performance is dominated by stocks that are expensive and popular, and on the other side, stocks that are unpopular and cheap had a tough year. The consequence of that is that the PSG portfolios underperformed relative to the MSCI world because we would have a strong preference for what is out of favor and what is currently very cheap. Our funds had a tough time in 2019. If we compare our performance, which lagged the market significantly, it was a consequence of us not being invested in the narrow group of stocks that drove the entire market performance. Those were gold, platinum, iron ore, and the Naspers complex. If we look on the other side of the market, the vast majority of stocks in the JSE had a tough year amidst poor economic conditions, and in particular as a result of a significant derating of the SA Inc. part of the market. The South African economy has been weak for some time, and the country is facing significant structural issues. The result of this is that confidence is incredibly low, and asset prices reflect this. We are often asked about the prognosis for South African assets given the structural issues that the country faces. While we are very cognizant of those issues and we acknowledge the significance of things like Eskom, what we do feel we need to point out is two things. The first is that prices, by and large, appear to be reflecting the very, very poor levels of confidence that are present, both from domestic investors and foreign investors. And we also think there's an opportunity to invest in both stocks and bonds where we think the underlying economics are robust. And if we look into the individual pricing of the securities, there's significant protection, even if the economic conditions remain dire. As our clients will be aware, we follow a 3M process. And this has us looking for companies of sufficient quality, but most importantly, not wanting to overpay and wanting to buy at a margin of safety. In recent years, we found good opportunity, but this has been in the unloved parts of global equity markets and unloved parts of the local equity market. These stocks have performed poorly, but we think there's significant value being offered to investors who are prepared to be patient. So we're excited about the long-term returns. We have been early into some of these positions, and they haven't paid off thus far. This 3M process sees us not being prepared to own companies that we think are overpriced. And if we look at the structure of global equity markets currently, there's significant parts of the market that are both loved and are trading at very elevated valuations. We struggle to see good long-term returns from this part of the market, and this sees us avoiding a number of sectors and stocks that feature largely in a number of portfolios out there. These would include the expensive large caps in the SA, in particular the technology sector, and it would also include parts of the South African stock market that are currently in vogue. The likes of Naspers, we believe, is expensive, and we think there's significant investment risk. And if we look at some of the mining companies that have performed so well in recent times, we think they're currently pricing in commodity prices that are not sustainable in a normal year. We think we can find far better opportunities for our clients, and we're applying capital to those opportunities and not to what everyone else seems to think is the place to be.